Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Us Foods Holding Corp. Annual Report. Us Foods Holding Corp. offers a wide range of businesses and services to various food service customers across the United States. The company's portfolio includes the distribution of fresh, frozen, and dry food products, as well as non-food items. Some of the key customer segments served by US Foods include independently owned restaurants, regional concepts, national restaurant chains, healthcare institutions such as hospitals and nursing homes, hospitality establishments like hotels and motels, private clubs, government agencies, military organizations, educational institutions including colleges and universities, and retail locations. The significant increase in US Foods Holding Corp's stock price by over 41% in the past year can be attributed to several key factors. The company's strong quarterly earnings reports throughout fiscal year 2025 were a major contributor to this growth. In each quarter, US Foods reported impressive increases in net income, adjusted EBITDA, and adjusted diluted EPS. The company's strategic initiatives also played a crucial role in its stock price increase. US Foods aggressively repurchased its shares through various share repurchase programs, allocating over $934 million to buybacks for the full year. Additionally, the company consistently gained market share, particularly within its target customer types of independent restaurants and healthcare customers. The successful implementation of digital transformation initiatives, such as the MOX e-commerce platform, further enhanced operational efficiency and customer engagement. Strategic acquisitions, cost savings, and improved efficiency also contributed to the company's financial performance. Furthermore, US Foods reduced its net leverage to 2.7x by the end of fiscal year 2025. The positive analyst sentiment throughout late 2025 and early 2026 was another significant factor in the stock price increase. Multiple analysts upgraded their ratings and raised price targets for US Foods, contributing to a consensus rating of moderate buy or outperform. These combined factors led to US Foods Holding Corp stock reaching a 52-week high of $102.13 and an all-time high closing price of $101.98 on February 12, 2026. US Foods Holding Corp market capitalization of $22 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that US Foods Holding Corp holds a significant advantage in their industry. US Foods Holding Corp trades at a higher price-to-earnings ratio of 34 times and a higher price-to-book ratio of 5.12 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 69% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets in equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through a thorough analysis of various factors. On one hand, revenue growth is driven by several key factors. Firstly, sales to top 50 customers and group purchasing organizations, GPOs, have been significant contributors to revenue growth. Additionally, the expansion of product offerings and value-added services has also played a crucial role in driving revenue upwards. Furthermore, customer growth in independent restaurants, healthcare, and hospitality sectors has contributed to revenue growth. The increase in case volume across these sectors, particularly in independent restaurants, healthcare, and hospitality, has been substantial. Moreover, the growth in sales to existing customers, including hospitals, nursing homes, hotels, and government organizations, has also contributed to revenue growth. On the other hand, revenue decline is driven by several factors. The decrease in chain volume and loss of major customers, or GPOs, have led to a decline in revenue. Additionally, changes in buying practices of independent restaurant customers and inability to grow current customer base have also contributed to revenue decline. Furthermore, decreases in sales of dry grocery products and refrigerated and frozen grocery products have also resulted in revenue decline. Overall, the primary drivers of revenue growth or decline are complex and multifaceted. While revenue growth is driven by a combination of factors including sales to top customers, customer growth, and expansion of product offerings, revenue decline is driven by factors such as loss of major customers, changes in buying practices, and decreases in sales of certain products. The net income of a company underwent significant changes between 2023 and 2025. Initially, it decreased from $506 million in 2023 to $494 million in 2024. However, this trend reversed in 2025, when the net income increased by $182 million to reach $676 million. This substantial increase can be attributed to various factors such as improved operational efficiency, effective cost management, and strategic business decisions. In terms of profit margins, the picture is more complex. The gross profit margin decreased from 17.3% in 2023 to 17.2% in 2024, but then increased to 17.4% in 2025. On the other hand, the operating income margin showed a steady increase from 2.9% in 2023 to 3% in 2024, and further to 3.2% in 2025. The net income margin also experienced an upward trend, rising from 1.3% in 2023 to 1.7% in 2024. The mixed results of profit margins can be attributed to various factors such as changes in market conditions, competition, and the company's ability to adapt to these challenges. Despite these fluctuations, the overall trend suggests that the company is moving towards improved profitability. The company's financial performance is a key indicator of its overall health and sustainability. A review of the operating cash flow reveals a positive trend, with an increase from $1,174 million in 2023 to $1,369 million in 2024. This significant growth demonstrates the company's ability to generate sufficient cash from its core operations. Furthermore, the free cash flow has also shown improvement, rising from $836 million in 2023 to $965 million in 2024. While there is a slight difference between operating and free cash flow, both metrics indicate that the company is generating positive cash flows from its operations. This suggests that the company's business model is robust and capable of producing sufficient cash to meet its financial obligations. The company's debt level has undergone significant changes over the past few years. According to the extracted summaries, total debt has increased from $4,928 million to $5,200 million, with a notable increase in long-term debt by 5.1%, $4,819 million to $5,063 million. Additionally, lease liabilities have risen by 17.1%, $781 million to $912 million, indicating an expansion of the company's financial obligations. However, interest expenses have shown a mixed trend. While there are instances where interest expense, net, has decreased from $324 million in 2022 to $305 million in 2024, and from $315 million in 2023 to $305 million in 2024. Other points suggest a slight increase or no significant change. For instance, interest paid, net of amounts capitalized, has increased slightly from $284 million in 2024 to $300 million in 2025. The most notable change is the increase in total debt and long-term debt, which has led to significant changes in interest expenses due to amendments in interest rate margins. The outstanding balance of unsecured senior notes due 2033 has also increased by $498 million, but with an unchanged interest rate at 5.75% per year. Overall, while there are some fluctuations in interest expenses, the company's debt level has undoubtedly increased, indicating a shift in its financial position. Management is outlining a clear vision for the company's outlook and strategy. The core mission is to empower chefs and food service operators to deliver exceptional dining experiences. To achieve this, the company will focus on three key elements: providing high-quality products, offering innovative tools, and ensuring timely deliveries through its We Help You Make IT strategy. The company aims to drive growth by addressing industry trends proactively, delivering personalized solutions, and investing in advanced technology and analytics. This will enable it to gain a competitive edge and build lasting customer loyalty. Management is also prioritizing sustainability and evolving dietary preferences through initiatives such as the Scoop program and Serve Good/Serve You. The company's business strategy is centered around leading quality and innovation through exclusive brands that meet operator concerns around profitability, staffing, and driving traffic. Additionally, management has entered into contractual relationships with group purchasing organizations, GPOs, to negotiate pricing and terms on behalf of their members. The company will selectively pursue acquisition opportunities in the future if they align with its strategic priorities. Overall, management's emphasis is on delivering high-quality products, investing in technology and analytics, and prioritizing sustainability and customer relationships. This comprehensive approach aims to drive growth, increase profitability, and establish the company as a leader in the industry. The company has made several significant acquisitions in recent years. In 2025, two notable acquisitions were completed: Jake's Finer Foods and Shataki's. These deals not only expanded the company's product offerings, but also provided an opportunity to leverage transferable tax credits worth $71 million. In addition to these acquisitions, the company has also made strategic divestitures to optimize its portfolio. One such example is the Freshway divestiture, which was mentioned in Note 5 of the Acquisitions and Divestitures section. Furthermore, the repayment of the 2019 incremental term loan facility, with proceeds from incremental term loans and senior notes, can be seen as a form of divestiture, allowing the company to reduce its debt burden. Overall, these acquisitions and divestitures demonstrate the company's commitment to strategic growth and optimization of its business operations. The company has a history of paying dividends and buying back shares. In terms of dividend payments, the company paid out $7 million in the first quarter of 2023 to holders of Series A convertible preferred stock. However, it's worth noting that no dividends have been paid on common stock since 2016. In addition to paying dividends, the company has also engaged in share buybacks through various programs. Between 2025 and the present day, a total of $934 million has been spent buying back shares under these programs. This effort to repurchase its own stock is a significant aspect of the company's capital management strategy. Supply chain disruptions pose significant risks. The extracted summaries reveal several concerns related to supply chain disruptions that could impact businesses and operations. These risks include inflation, tariffs, trade policies, and geopolitical events, page 11. Furthermore, a long list of potential disruptions is mentioned on page 12, including higher costs, labor shortages, government shutdowns, severe weather conditions, product or raw material scarcity, and more. These disruptions can have significant financial and operational consequences for businesses. For instance, higher fuel costs may increase delivery costs and reduce consumer spending, page 13. Climate change also poses a risk to the business, both directly and indirectly, creating potential financial and operational risks, page 13. Additionally, disagreements with suppliers regarding contracts or compliance with laws and regulations can lead to supply chain disruptions, page 15. These concerns highlight the importance of considering these risks when planning and managing supply chains. That concludes the financial summary for Us Foods Holding Corp. Feel free to comment below, and I will be happy to answer them when possible.